Saving and investing are not the same thing, and understanding the difference can completely change the way you manage money. A lot of beginners hear these two words and think they mean almost the same thing. Save money, invest money, grow money, build wealth. But saving and investing have very different jobs. Saving protects your money. Investing helps your money grow. Saving is about safety. Investing is about long-term growth. Saving gives you stability. Investing gives you opportunity. And if you use the wrong one at the wrong time, it can create problems. For example, if you invest money you need next month, you may be forced to sell at the worst possible time. But if you only save money and never invest, your money may stay safe, but it may not grow enough over time. So the goal is not to choose saving or investing. The goal is to understand when to use each one. Before we go deeper, remember that this video is for educational purposes only and should not be considered financial advice. Everyone's financial situation is different, so always make decisions based on your own goals, income, risk tolerance, and personal circumstances. Now let's start with saving. Saving is money you keep safe and easy to access. This is money for short-term needs, money for emergencies, money for bills, money for planned expenses, money you may need soon. Savings are not meant to make you rich quickly. Savings are meant to protect you. Think about your savings as financial defense. If your car breaks down, savings protect you. If you lose your job, savings protect you. If you have an unexpected medical bill, savings protect you. If rent is due next month, savings protect you. If you need money soon, that money should usually not be exposed to major market risk. This is why your emergency fund should usually be saved, not invested. An emergency fund is money set aside for unexpected expenses. It gives you breathing room when life happens. Without savings, even a small emergency can become debt. A surprise repair goes on a credit card. A medical bill becomes a loan. A job loss becomes panic. But with savings, you have options. And options are one of the most powerful things money can give you. Now let's talk about investing. Investing is money you put into assets with the goal of long-term growth. This could include index funds, ETFs, stocks, retirement accounts, real estate, or other long-term assets. Investing is not about keeping money perfectly safe every single day. Investing is about giving your money a chance to grow over years and decades. That growth can come from business profits, market returns, dividends, compound interest, or rising asset values. But investing comes with risk. The value can go up. The value can go down. Some years may be good. Some years may be bad. Sometimes the market can fall quickly. Sometimes it can take time to recover. This is normal. But it is also why investing is usually better for long-term money, not short-term money. If you invest money you need in 6 months, the market may not care about your timeline. You may need the money exactly when your investments are down. And if you are forced to sell during a bad moment, a temporary drop can become a real loss. This is one of the biggest beginner mistakes. They invest money they cannot afford to leave alone. Then the market drops. They panic. They sell. And they feel like investing does not work. But often, the real problem was not investing itself. The problem was using investment money for a short-term need. That is why time horizon matters. Short-term money should usually be safer. Long-term money can usually take more risk. Let's make this simple. Money you need in the next few months should usually be saved. Money you need in the next 1 to 3 years should usually be kept safer. Money you do not need for many years may be invested. This is not a perfect rule for every situation, but it is a helpful beginner framework. Because every dollar needs a job. Some dollars are for protection. Some dollars are for bills. Some dollars are for emergencies. Some dollars are for future growth. When you know the job of the money, the decision becomes clearer. Now let's talk about inflation. Inflation means prices increase over time. The same amount of money buys less in the future than it buys today. This is one reason why keeping all of your money in cash forever can be a problem. Cash feels safe because the number does not move much. But if prices keep rising, your buying power can slowly fall. For example, if you keep money in cash for many years, the amount may look the same, but what it can buy may become smaller. This is why investing matters. Investing gives your money a chance to grow faster than inflation over the long term. But again, this does not mean all money should be invested. Emergency money should be protected. Short-term money should be accessible. Long-term money can be given room to grow. The key is balance. Saving protects your present. Investing builds your future. You need both. If you only save, you may feel secure in the short term, but you may not build enough wealth over time. If you only invest, you may build long-term growth, but you may feel stressed when emergencies happen. A strong financial foundation usually starts with saving first. That does not mean you need to have everything perfect before investing. But having some emergency savings can prevent you from making bad investment decisions during stressful moments. For beginners, a good first step is to build a basic emergency fund. Even a small amount can help. Maybe your first goal is $500. Maybe it is $1,000. Maybe it is 1 month of basic expenses. The exact number depends on your life, but the purpose is the same. You want a buffer between you and financial panic. After that, you can build toward a stronger emergency fund while learning about investing. Many people talk about 3 to 6 months of expenses as a long-term emergency fund target. That can be a great goal, but do not let it scare you if you are starting from zero. Start small. Build the habit. Then increase it over time. Now, once you have some savings protection, investing becomes easier to handle emotionally. Why? Because you know you do not need to sell your investments every time life happens. Your emergency fund handles emergencies. Your investments stay focused on the long term. This separation is important. Your savings account should not be treated like an investment account. And your investment account should not be treated like an emergency fund. They have different jobs. Savings are for access. Investments are for growth. Savings reduce stress. Investments require patience. Savings are stable. Investments can move up and down. Now let's talk about another common mistake. Waiting too long to invest because you are trying to feel perfectly ready. Many beginners think they need to understand everything before they start. They think they need to know every stock, every chart, every economic report, every market prediction. But investing does not need to start with complexity. For many beginners, the first step is simply understanding the basics. What is risk? What is diversification? What is long-term investing? What are fees? What is compound growth? What happens when markets go down? You do not need to become an expert overnight. You just need to start learning and make thoughtful decisions. Another mistake is trying to invest without a plan. Some people hear about a hot stock, a popular trend, or something everyone is talking about. They put money in because they do not want to miss out. Then when the price drops, they panic. This is not investing with a plan. This is reacting to noise. A better approach is to know why you are investing. Are you investing for retirement? For long-term wealth? For a future goal 10 or 20 years away? Your reason matters because it helps you stay patient. When you understand your time horizon, market drops become easier to handle. They may still feel uncomfortable, but they do not automatically mean you should quit. Investing requires patience because growth is not always smooth. There will be good months. There will be bad months. There will be years when the market feels exciting. There will be years when it feels stressful. But long-term investing is not about reacting to every movement. It is about staying consistent with a plan that fits your goals and risk tolerance. Now let's compare saving and investing side by side. Saving is best for short-term goals. Investing is best for long-term goals. Saving is lower risk. Investing has higher risk. Saving is more accessible. Investing may require patience. Saving protects you from emergencies. Investing helps build wealth over time. Saving is defense. Investing is offense. And both are necessary. Think of it like building a house. Your savings are the foundation. Your investments are the structure you build on top. If you try to build without a foundation, everything feels unstable. But if you only build the foundation and never build upward, you do not reach your full potential. That is why beginners should not ask, should I save or invest? A better question is, what is this money for? If the money is for next month's rent, save it. If the money is for an emergency, save it. If the money is for a vacation next year, keep it safer. If the money is for retirement decades from now, investing may make more sense. If the money is for long-term wealth, investing may be the tool. The purpose decides the strategy. So here is a simple beginner plan. First, track your basic expenses. Know how much money you need each month to keep your life running. Second, build a starter emergency fund. Even a small buffer is better than no buffer. Third, separate short-term money from long-term money. Do not mix money you need soon with money you can leave invested. Fourth, learn the basics of investing before chasing returns. Understand risk, diversification, fees, and time. Fifth, stay consistent. Saving and investing both work better when they become habits. Because wealth is not built by one decision. It is built by repeated decisions. Saving a little, investing a little, learning a little, avoiding emotional mistakes, staying patient, and improving over time. Saving protects your life today. Investing builds your life tomorrow. You need both. Use savings for safety. Use investing for growth. And give every dollar a clear purpose. That is how money becomes less confusing. That is how you build confidence. And that is how small habits begin to create long-term wealth. Wealth isn't built overnight. It's built by habit. If this video helped you, like the video, subscribe, and turn on notifications for more simple videos about money habits, investing, and long-term wealth.